S&P futures are slipping 0.8% this morning, and Dow E-minis are down, well, more than 1%.
Yeah, Nasdaq futures are bleeding out, too.
Right, and the pre-market bell hasn't even run yet on this Wednesday morning, July 8th, 2026. So if you're an active trader looking at the implied open, you are staring at, like, a massive illusion.
Oh, absolutely. I mean, the surface tape looks technically neutral to the untrained eye, but under the hood, the foundation of the market is aggressively fracturing.
Fracturing is the right word.
Yeah, because the pre-market volume tells a completely different story. We are tracking a massive, violent rotation happening right now in the overnight session.
Just a total liquidity sweep.
Exactly. Capital is actively fleeing, and it's being driven by a sudden geopolitical shock colliding head-on with a pretty severe semiconductor shakeout.
And that is exactly our mission for this deep dive. We have a heavy stack of institutional financial briefings, overnight market flow data, sector analyses, you name it, sitting right in front of us.
Lots of data to chew on today.
Tons of it. And our goal today is to cut through all that headline noise, examine the specific levels and tickers making moves in the pre-market, and uncover the pain trade that retail investors are currently, walking right into.
Right into a trap.
Okay, let's unpack this, because we need to start with the absolute catalyst that set today's global market volatility on fire.
Yeah, the catalyst is a sudden, sharp geopolitical escalation in the Middle East. Over the course of the overnight session, the global macro narrative completely flipped.
Completely flipped. Now, before we go any further, I want to be absolutely crystal clear with you, the listener, right up front. We are strictly reporting these geopolitical developments directly from the institutional sources, solely as market catalysts.
Right. Strictly the numbers in the tape.
Exactly. We take absolutely no political side here. The facts driving the market are these. President Trump has officially declared the U.S.-Iran ceasefire and peace memorandum over.
Which was a massive shock to the overnight desks.
A huge shock. And this announcement was followed immediately by U.S. military strikes on Iranian targets, which then triggered Iranian retaliatory strikes on military sites in Bahrain and Kuwait.
And the algorithmic market reaction was just instantaneous. I mean, Brent crude spiked nearly 6% in the overnight session to top $78.35 a barrel.
6% overnight is wild.
It's massive. And WTI crude is also up over 5%. When you have military strikes occurring that close to the Strait of Hormuz, the automated institutional commodity desks, well, they don't wait for confirmation.
No, they shoot first and ask questions later.
Exactly. They instantly buy futures contracts because they have to price in the mathematical probability of severe supply disruptions in, critical global energy corridors.
It is literally like watching a lit match get thrown into a bone-dry forest.
That's a great way to put it.
But I want to push back on this for a second, because look, we've seen oil spike before, we've seen geopolitical headlines gap the market down before, and usually the market absorbs it after a few days of panic, right?
Sure, historically, yeah.
So why is this specific surge such a massive structural problem for the broader stock market today?
What's fascinating here is that oil is officially back in the inflation driver's seat. At the exact moment, the market mathematically cannot handle it.
Right.
What you're seeing right now is capital frantically fleeing overstretched tech valuations to find immediate shelter in hard assets. The pre-market leaders are telling the whole story here.
Let's hear the tickers.
So ExxonMobil is up 3.0%. APA Corp is up 4.2%. Chevron's gaining 2.4%. These oil and gas giants are acting as the market's primary geopolitical hedges right now.
Let's drill down into the mechanics of that Chevron trade for a second. Ticker CVX. Because the institutional flow isn't just blindly tracking that 5% crude surge.
No, there's a fundamental play there too.
Right. Investors are pairing this macro tailwind with Chevron's organic volume growth, specifically leveraging that recent Hess integration.
Yeah, those Hess assets give Chevron incredible leverage to higher oil prices.
Exactly. So if oil remains bid above $75 on the WTI, the institutional briefings are targeting a bull case brainout level of $180 to $185 for Chevron.
Yeah, it's a huge upside.
It really is. But, if diplomatic tensions cool off, that double bottom level from early July, around $165 to $167, that is the absolute must-defend floor for the bulls.
And that energy spike is exactly what leads us to the broader, far more dangerous macro problem. You just cannot look at energy in a vacuum today.
Right, it bleeds into everything.
Exactly. A 6% spike in crude oil doesn't just stay in the energy sector, it bleeds directly into the inflation data.
Because that energy shock is actively forcing the Federal Reserve's hand.
Yeah.
If you are sitting at home hiding out in mega cap tech today, assuming your Apple or Nvidia shares are safe, you are facing what the institutional desks are calling the double-headed dragon.
The double-headed dragon, I love that term.
Yeah, and functionally, this dragon acts as a twin liquidity vacuum.
It is just a brutal environment for growth stocks right now.
I want to break down the two heads of this dragon because the mechanics are staggering. First, the 10-year U.S. Treasury yield. It is surging this morning to 4.54%, pushing 4.55%, hitting a multi-week high after a relentless run of consecutive up sessions.
It just will not stop climbing.
It won't. Second, the U.S. dollar index, the DXY, is pushing higher to 101.13 on massive safe haven bidding.
Right.
And this is all happening under the new Fed chair, Kevin Warsh. The Warsh regime has entirely abandoned explicit forward guidance.
Which means they are no longer holding the market's hand with predictable policy updates.
Exactly. And they just raised 2026 PCE inflation projections to 3.3%.
Those numbers represent a severe coordinated structural headwind. I mean, when you have the risk-free rate of return on the 10-year Treasury spiking to 4.55% and the dollar strengthening past 101, the basic math of the entire stock market fundamentally breaks down.
Here's where it gets really interesting, though. Because retail investors came into 2026 heavily positioned for aggressive rate cuts.
Oh, heavily positioned.
You probably saw the headlines all winter. Retail built portfolios, assuming the Fed was going to provide a safety net of easy money. But if retail is waiting for a rescue, what are the institutional derivatives markets actually pricing in right now?
A total shock to the system. The derivatives market is now pricing in a roughly 50% chance of a Federal Reserve rate hike by September.
That hike, not a cut.
Not a cut, hike. And to understand why the 10-year and the DXY are acting as a twin liquidity vacuum against tech specifically, we have to look at two concepts from the morning briefings: discount rate gravity and repatriation friction.
Okay, I'll take a stab at explaining discount rate gravity, and you tell me if I am tracking this correctly.
Go for it.
So highly valued tech and semiconductor giants don't trade on the cash they are making today. They trade on massive expected future cash flows, like 5 or 10 years down the line.
Right. It's all about the future multiples.
Exactly. So when the yield on the 10-year Treasury spikes, the discount rate that analysts use to calculate the present value of those future earnings also spikes.
Correct.
So a higher yield literally acts like gravity, pulling down high valuation multiples because those future profits are mathematically worth less in today's dollars. Am I hitting the mark there?
You nailed it. It's just gravity. The higher the risk-free yield, the harder it is to justify paying a massive premium for a tech company's future growth.
Because why take the risk?
Exactly. Valuations simply must compress because investors can get 4.55% completely risk-free from the government.
Right.
Why take a massive risk on a speculative tech stock for a similar return?
Just doesn't make sense. And the second part of this is repatriation friction, which I like to think of as a massive foreign exchange toll booth.
A toll booth, that's a good analogy.
Yeah, this comes directly from the U.S. dollar index pushing past 101. A strong U.S. dollar actively hurts multinational tech giants.
Because of the conversion rates.
Right. When a massive company sells cloud software or hardware overseas in Europe or Asia, they are collecting foreign currency. But when they have to drive through that exchange rate toll booth to convert those foreign sales back into expensive U.S. dollars to report their quarterly earnings to Wall Street, they take a massive haircut.
That is the perfect way to look at it. The toll booth takes a huge cut of their revenue.
It's brutal.
It is, because it directly crimps upcoming earnings reports without the underlying business fundamentally changing. The company might be selling the exact same amount of software, but because the dollar is so strong, their reported revenue just drops.
So you have tech valuations getting compressed by yield gravity and tech earnings getting eaten alive at the dollar toll booth. That is a brutal whiplash.
And it shows perfectly in the semiconductor rotation today. The sector is aggressively risk-off.
Yeah, the leading structural indicator here is South Korea.
Which is basically the global manufacturing floor for high-end tech.
Exactly. Samsung just reported blowout earnings, but it completely failed to sustain the AI hype in the broader market. The South Korean Kospi index plunged 5% today.
5%. That's heavy.
It has officially entered a technical bear market, and that is dragging global tech indices down in sympathy. But amid all this macro gravity, there are always massive outlier moves.
Always. There's always somewhere to hide.
Let's talk about the first one up, Alibaba, ticker BABABA.
Yeah, Alibaba is completely defying the broader tech carnage this morning, surging over 11% in pre-market volume.
11% on a day when the Nasdaq is bleeding out.
Right, and the source material points to a major U.S. federal court ruling that temporarily blocked a Pentagon lobbying ban against them.
So the regulatory cloud is lifting.
Exactly. By removing that existential tail risk, the market is suddenly willing to look at their fundamentals again. You pair that geopolitical relief with reports of blockbuster 45% growth in their cloud division.
And you have a massive gap and go scenario.
It really highlights a critical dynamic for active traders today. In a market starved for immediate realized growth, an undisputed 45% expansion in a high-margin cloud division will completely override the broader macro headwinds.
But that same macro environment is entirely merciless to companies that lack immediate cash flow.
Oh, it will crush them.
Yeah, if Alibaba is thriving because of actual realized cash flow, let's look at a company that is essentially ripping the copper wiring out of the walls just to pay the mortgage.
RIVN.
Take RIVN, for example, ticker RIVN. This chart is agonizing. Down 18.12% yesterday, down another 4% in the pre-market today.
It's just falling off a cliff.
They priced a 75 million share public offering at $15.50 to raise $1.2 billion.
And the institutional note makes it crystal clear this is a pure survival dilution play just to keep their Department of Energy loan agreement active.
So what does that mean mechanically for the stock?
Well, mechanically, that $15.50 offering price establishes a very precarious floor in the options market. The bear case level here is $14.50 to $15.
And if that breaks?
If persistent algorithmic selling cracks that $15.50 floor, the market makers who underwrote that offering will have to start dynamically hedging, which means they will short the stock to protect themselves.
Adding more fuel to the fire.
Exactly. Expect RIVN to plummet back to its mid-$14 base if that happens. For the bulls to reverse this technical damage, they have to reclaim the pre-offering breakdown level at $18.60 and close that massive overhead gap.
But in a 4.55% interest rate environment, taking on survival dilution is punished severely by institutional capital.
Extremely severely.
Which is the exact opposite of how the market is treating our third outlier today, Nasdaq, ticker MTZ.
Yeah, this chart is fascinating today.
They fell 5.72% during regular trading hours to close at $358.85, but then surged over 5% in the after hours near $377.
A massive reversal.
Why the massive reversal? They announced a $1.65 billion cash and stock acquisition of the Superior Group. It's a critical infrastructure contractor serving the hyperscalers, those massive tech giants, eating up all that cloud and data center space.
And here is the contrast that active traders need to understand. Nasdaq is taking on $700 million in new term debt to fund the cash portion of this deal.
Right. And usually taking on new debt in a high-rate environment is a massive red flag.
A huge red flag. But the market is heavily rewarding them. Why?
Because it is accretive.
Exactly. It is an immediately accretive cash-flowing infrastructure play tied directly to the physical build-out of data centers. They aren't borrowing money to survive like RIVN.
Right. They're borrowing money to instantly generate more revenue.
Yes. So the bull case level targets $400, testing major psychological resistance. However, if investor skepticism over that debt load returns during the regular session, yesterday's intraday low of $348 is the bear case line to watch.
Okay, so we have oil acting as an automated geopolitical hedge, yields and the dollar acting as gravity and toll booths on tech, and a stark divide between companies diluting for survival and companies acquiring for immediate cash flow.
That's the lay of the land.
So what does this all mean for you, the listener, trying to navigate this morning's chaos? Let's hit the lines in the sand for the major indices.
Yeah, this is where the mechanics of the market structure become critical. Sellers are aggressively hitting the bid this morning, but they are smashing straight into major long-term institutional support zones.
I am going to read the exact levels from the institutional briefings, and I want you to explain why these specific zones are the battleground today.
Sounds good.
For S&P 500 futures, the ES, the line in the sand support zone is 7,485 to 7,495. This is the make or break intraday bull bear zone.
the absolute line in the sand.
Right. A clean hourly close below 7,485 shifts control entirely to the bears, opening the door for a deeper flush towards 7,450.
Right.
On the upside, resistance is at 7,550, which was the prior session settlement, and above that, the heavy consolidation ceiling from June at 7,600. So why is 7,485 the magic number today?
Because that is exactly where the massive institutional algorithmic tries are parked. It aligns with heavy options expiration positioning.
So it's all about dealer hedging.
Entirely. If the index drops below 7,485, the dealers and market makers who sold those options are suddenly off sides. To hedge their exposure, they have to mechanically short the underlying index, which just accelerates the selling pressure.
It's like a structural trapdoor.
Exactly what it is.
And what about the Nasdaq futures, the NQ? The line in the sand support is 29,274 to 29,300.
Right.
If 29,274 fails, the briefing says to expect a rapid test of the psychological 29,000 boundary. Resistance is at 29,400, which is the 50-day moving average, and a heavy overhead supply zone between 29,800 and 30,000.
If connect this to the bigger picture, these levels aren't just arbitrary lines on a chart. They are the structural battleground for the real pain trade.
The pain trade. Tell me about that.
Right now, retail investors are blindly buying the dip in overcrowded, hyper-expensive AI and semiconductor names. They're assuming the Fed will rescue them, completely ignoring the fact that derivatives are pricing in a potential September hike.
Wow. And while retail is hitting the buy button on margin, what are the institutions actually doing?
The order flow data shows that institutions are executing low time frame liquidity sweeps below those weekly lows.
Hunting for stops.
They are essentially hunting for retail stop losses. They use the retail dip buying as liquidity to structure and mask their own institutional positioning.
So what are we actually looking at right now? Is this a structural bearish breakdown, or are retail shorts about to get entirely wiped out?
The institutional consensus right now is that this is a classic liquidity trap, specifically a bear trap.
Okay. How does that work mechanically?
Here's how it goes. Late retail shorts wake up, see the geopolitical headlines in the pre-market red, and they aggressively short the market at the absolute bottom of the range.
Hoping for a bigger crash.
Right. But if the institutions step in and defend that 7,485 level on the S&P and the Nasdaq holds 29,274, this trap will violently spring shut.
Squeezing the late shorts.
Yes. The late shorts will be forced to buy back the stock to cover their losing positions, creating a mechanical short squeeze that propels the market right back into the summer consolidation range.
But there is a much darker side to this if those institutional support levels break, right? What if 7,485 on the S&P actually fails and the market makers start hedging downward?
Then the pain trade flips from a bear trap into a vicious liquidation squeeze.
A liquidation squeeze.
If those support lines break, the over-allocated growth portfolios that have been relying heavily on margin and leverage will be forced into margin calls by their brokers.
And you can't negotiate a margin call.
No, you don't get to choose what you sell. You have to systematically liquidate your winning positions just to cover your leverage requirements. That is when you see a deep, uncontrolled flush across the entire market, regardless of fundamentals.
It just washes everything out. So the game plan for you today is incredibly clear. Do not chase this pre-market breakdown blindly. Keep your risk extremely light until you see how the daily candles actually close around these major support zones.
Let the market show its hand first.
Exactly. So let's summarize the core insights from today's stack of briefings before the bell rings. First, the geopolitical flare-up between the U.S. and Iran has suddenly made energy the ultimate safe haven hedge, with oil surging past $78 and algorithms aggressively bidding up names like Chevron.
Yep.
Second, those resulting inflation fears have effectively killed the retail dream of aggressive rate cuts, driving the 10-year yield and the U.S. dollar to heights that act as gravity and toll booths, actively suffocating tech valuations.
So long.
And finally, tech itself is facing a massive structural reckoning caught squarely between a bear track at major support levels and the very real threat of a cascading liquidation squeeze.
It is a phenomenal setup for active traders who respect the data and the mechanics, but an absolute minefield for anyone trading on outdated, easy money assumptions about the Fed.
For sure.
And actually, this raises an important question, something that isn't printed on the front page of these institutional briefings, but is absolutely critical for you to consider today.
Oh, I love it when you spot the hidden angle. What is the contrarian question we need to be asking?
So right now, everyone is crowding into energy names like Chevron and Exxon, treating oil as the ultimate bulletproof geopolitical safe haven. The fear premium is fully priced into those stocks as of this morning.
Right, everyone is long oil.
But what happens if diplomatic back channels suddenly cool these tensions overnight?
Oh, wow. If the geopolitical risk premium vanishes.
Exactly. If a new ceasefire is negotiated or tensions de-escalate as fast as they flared up in the overnight session, the most crowded safe trade in the entire market could instantly become its most dangerous bubble.
They'd all be offsides.
Late buyers chasing energy at the absolute top could be left holding the bag as the fear premium deflates, while tech violently gap and goes in the other direction. The market is pricing in sustained structural conflict today, but peace or even just a temporary diplomatic pause is the ultimate contrarian risk right now.
That is exactly why you have to keep your head on a swivel today. Don't assume that a geopolitical shock will structurally disrupt the market forever. Sometimes the diplomatic winds just change direction overnight.
You have to be ready for the pivot.
Keep your eyes locked on the 10-year yield. Respect those institutional lines in the sand. And we will see how this high-stakes tug-of-war resolves at the open. Thank you for joining us for this deep dive, and we'll catch you next time as we continue to unpack the tape.